Hello and welcome to a special year ahead episode of Bondcast, our podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, head of non-dollar rate strategy, and I'm joined today by our global market specialists, Jan Nevruzi and Joann Spadigam. Okay, like I said, today is our special year ahead episode. So instead of concentrating on the events in the week just gone or what we're looking forward to in the weeks coming up, we're going to take a bit of a big picture view this week and think about the themes and events that we think will shape fixed income in the years, I suppose, to come. I guess somewhat unusually, or it feels a bit unusual, we have a fairly synchronized set of key themes for global fixed income next year, or at least that's what it feels like. I think yields in a very large part will be driven by the turn in monetary policy. Across the board, we're expecting 2024 to be about the pivot, whereas 2023 was very much about reaching the peak. And of course, we'll go into the detail of when we see those different pivots, but that will be one key driver of yields. But of course, offsetting that, you also have these still very large fiscal deficits and plenty of supply, which means that yields, at the end of next year, in our view, probably won't be as low as you would expect if you were just to consider that kind of change in monetary policy in a vacuum. So I guess the very high level views before we get into the detail from us is somewhat lower yields, and we'll go through kind of region by region what we mean by that and what yield targets we have, but definitely steeper curves and clearly a bit of kind of cross-market underperformance for those economies where we expect this supply narrative and the large fiscal deficits to weigh more. But let's kind of drill down into what that all really means. I guess when we think about the year ahead, one of the ways in which we want to be a little bit more interesting, I suppose, is to start off with our most off consensus calls. And I think for all of us, if you look at the way in which the market is priced, which the forwards are pricing for the next 12 months, let's say, where we would be most off consensus across all three regions is at the front end of the curve. And that's, of course, driven by what we think about monetary policy and monetary policy expectations. So perhaps that is the most logical place to start. Jan, I'll start with you because I think you're where we are most off consensus in the US with the Fed call. Particularly in terms of the kind of scale of the easing that we're expecting. So perhaps you can just talk us through that, the kind of drivers and what your call really is there.
Yeah, like you said, we are probably most of consensus in the US, and as we expect interest rate cuts to begin in May at a 50 basis point cut per meeting. So it's quite the elevated pace, and I'll get to the reasons why, but as we go through the year, we see the Fed finishing basically kind of like reaching their terminal rate, plateauing at 3.25, so 3 to 3.25 range, which, like you said, I think is pretty off consensus given the estimates that I've seen floating out there. Similar to the Fed's dot plot forecast, I think generally economists have really diverged in how they see the economy developing, whether we get a recession, whether we see inflation slowing down, and how much the Fed cuts alongside. To just give you what underpins our view, and I'll compare and contrast it to what the Fed has in their forecasts. We do see, first of all, growth slowing down, right? We have Q4 over Q4 growth for GDP at 0.5 percentage point, but that still kind of overlooks the fact that we do see a recession in the middle of the year, starting from Q2 to Q3. Now, that's not a very deep and severe recession, but it's still one nevertheless. The Fed's growth expectations, at least the ones submitted in September, were markedly higher than ours. Similarly, we see inflation as measured by core PCE, the Fed's preferred inflation gauge, is coming down much faster than what the Fed has. The medium forecast that the Fed had was 2.6% for next year. We see it coming down to 2.1%. So essentially back to target. And finally, I think this is the key part, is the unemployment rate. The Fed's median forecast was 4.1% for end of 2024 unemployment. Ours is 5.4%. So a very, very big difference. Even by the middle of the year, when we expect to see interest rate cuts to begin, we have unemployment at 4.5%, which is higher than their forecast for next year. So it is important to just remind listeners, or like for all of us, remind ourselves that the Fed's mandate is, a dual mandate. It's not just inflation, but it's also unemployment. So if we see inflation trending sustainably towards target, it will be very hard to ignore the, an upward momentum in unemployment, and they will simply adjust monetary policy to get it closer to what will be more either a neutral stance or slightly looser stance. Now, the neutral rate estimate is still at 2.5%. We could see that going up, call it some 50 basis points to 3%, which, or maybe even if it was slightly higher than 3%, which again, that's a pretty gradual process. But let's just say we get there, the Fed might want to be even below that, even if it's increased, just to kind of be a little bit more stimulative from the unemployment side. I think because of so much recency bias in how inflation was the number one priority, we forgot that the Fed has to be active about the moment. Because of that, we expect cuts to come in 50 basis point increments in June and May. And for what it's worth, we don't even see any more hikes in this cycle. And markets more or less kind of converge to where we saw that anyway.
Joann, in Europe, we're less off consensus, I suppose, in terms of the scale of the easing, what we're calling for in terms of, the basis points amount of cuts next year isn't all that different to what the market has priced in. But we're more off consensus in terms of the timing, I would say, for the ECB. And I guess that's especially interesting, particularly given, that comes at the same time that we've had comments from, Lane and more recently Lagarde talking about this idea of, rates remaining at these higher levels for sufficiently long, and that long specifically refers to, I think they said, at least a couple of quarters. So how do you kind of square our more dovish view in terms of the timing with what ECB members so far have been saying?
So the markets have seemed to price in this 100 basis points quite quickly. There was a point in time where that was also off consensus, but for now, it does seem to be fairly well baked in for now. I think, obviously, like you said, the timing really does become crucial in this kind of scenario, where we kind of think that cuts could potentially come as soon as March, versus the forward guidance that the ECB is really giving, which suggests that could come around midway next year. To that, I mean, I think there are a couple of things on that. I think, firstly, the ECB is not going to be wedded by their forward guidance, and they've kind of proved this in the past. So I don't necessarily take everything they say at face value, and I do think it's worthwhile taking those comments with a pinch of salt. And I do think that the second kind of thing I would point out too is that rates are restrictive at this point. And I think that with inflation coming down, if you do leave rates at this level, it does mean actually that rates are becoming even more restrictive into next year. So I think there is this question of actually, will the ECB be just tightening rates by leaving them on hold versus cutting? And I think that's an important part of the puzzle as well. The next key event really is the ECB meeting in December, where we could potentially at that point get a reduction in the growth and inflation forecast for next year. And I think that, of course, will come as a bit of a dovish move in terms of what that means for market pricing, and could suggest perhaps that these rate cuts that we talk about in March could become more of a reality than is priced in at the moment. Just in mid-October, markets were pricing in close to no chance of any sort of cut in March, and that's changed quite drastically now, with around 25% being priced in for March of a 25 basis point hike. So I mean, things do change, and I do think that central banks will be responsive to that and will, I suppose, change their stance along with what's been happening in the market and along with how data really pulls itself forward. So Imogen, in terms of the BOE view, I think it's a little bit of a mix of the two. So slightly earlier, slightly more cuts than the market is pricing in at this point. So what's really driving that, and which way do you think the risks are skewed in the UK?
Yeah, you're right. We are, like you say, a kind of mix in terms of the off consensus view. Our central scenario is unchanged from what we've discussed on this podcast over the last couple of weeks. So we see 50 basis point cut in August, and then another 50 basis points in November. So 100 basis points of cuts in 2024, which would take bank rate to 4.25%. That compares to market pricing currently of just shy of 70 basis points. Obviously, that's moving around quite a bit at the moment, but we're probably settling somewhere around sort of 70 basis points of cuts being priced currently. So, like you say, a little bit more dovish in terms of the scale of easing, but also in terms of the timing, and that we expect that first 50 basis point cut to come in August. That's really driven by this kind of idea that we think, probably given the lags in monetary policy, actually the Bank of England have already tightened enough, and in fact, perhaps over tightened. There's still a fair degree of tightening in the pipeline to still be delivered. And that will present quite a significant headwind, both to the consumer and to businesses in 2024. So we have a fairly weak growth profile, not just in 2024, but in 2025 as well. We pretty much have a stagnating economy. We've talked a lot on this podcast and in our written research or written strategy notes around whether central banks can achieve a soft landing or not. But for the UK, I think the concern should be much more about how growth reaccelerates after this landing rather than, whether it's soft or hard. So we have flatlining growth essentially for a multi-year period, and inflation coming off back towards the Bank of England's target, essentially reaching 2% by the end of 24. That combination of weak growth and slowing inflation should be enough to allow the BOE to kind of take its foot off the gas when it comes to monetary policy by sort of Q3 next year, we think. We have them going in 50 basis point clips, largely because of this lag transmission mechanism of monetary policy that I've mentioned on the way up in this hiking cycle. We think they'll probably just want to cut in larger increments on the way down to get kind of back towards or back closer towards a more neutral level. We think that they will wait until at least the second half of the year, because I think, central banks globally are quite wary of kind of second round effects. And so they will need to see very clear evidence of, inflation really transitioning close towards their 2% target, the activity data very clearly turning over. And I guess importantly in the UK as well, a kind of loosening in the labour market to a larger extent than what we've seen already. And it won't be until we've kind of had concrete evidence of that, and they become much less fearful of second round effects, that I think that they will be comfortable loosening the policy rate. I think the risks in the near term are probably skewed towards more rather than less tightening though, and that really centers around the kind of New Year wage discussions. One of the calls that I think we and the market got most wrong in 2023 was kind of the persistent tightness in the labour market and the extent to which firms would be able to pass on higher wages to the consumer. And if that persists into early 2024 and wage inflation doesn't come off as we expect, then the Bank of England may have to kind of bear down more on domestic demand pressures, and that may require further tightening than we're expecting. But I think at the moment the market is probably fairly pricing in those risks. We have about 5-ish basis points of additional tightening between now and February being priced into the market, which is roughly 25% chance of another 25 basis point hike, which feels probably about fair, I would say. So I guess if you take at face value all of our kind of front end views when it comes to monetary policy, we're expecting relatively significant easing across the board. Looking at that, like I said at the beginning of the pod, looking at that in a vacuum, you would probably expect us to have quite significantly lower yield targets by year end 2024. But as it happens, although we do see lower yields next year, I would probably argue that they're still quite elevated if you looked at a long-term history. To put that into context, very easy to remember, our Treasury and gilt forecast, 10-year Treasury and gilt forecasts at end 2024 are 4%, and our Bund target is 2.3%. So yes, lower than here, but we're not talking about hundreds of basis points worth of a rally. And I think one of the big drivers that we expect to keep kind of curve steep and longer dated yields high is this the fiscal backdrop, this idea that deficits are still going to be very very large. There'll still be plenty of supply. And of course, you add to that, we expect QT, quantitative tightening, to continue across all three regions, even as central banks start cutting their policy rate. So, Jan, let's start with you again, because I think on the US side, although you expect supply to still be heavy next year, you're probably less worried about supply indigestion, I suppose, than we might be on this side of the Atlantic. What's driving that view?
I think I look at the worries around supply as having three possible main fixes. First, starting with the composition of issuance, the US still has, I think, plenty of room to absorb, or at least be able to shift duration of their issuance into the front end. We see net positive bill issuance in the US, but not really anything close to the extent that we had in 2023. I think given where RRP is currently, seasonality in how cash flows look like, we will, well, first of all, under our current forecast, don't even see the overnight RRP facility draining out until late Q3, early Q4 next year. So if Treasury wanted to take advantage of the kind of the funds that are trying to find short-term investments, they can shift issuance to into the bill side and away from longer dated paper. That's one. The second is, if the Fed actually is worried about the economy, and if things do slow down faster than we expect, even though we have QT as lasting through the entirety of next year with rate cuts alongside, we can see a scenario where the Fed also might want to stop QT, right? If supply does become a kind of a central topic of discussion for pushing yields higher, if the Fed wants to actually not have yields going higher, a pretty straightforward way would be to just pause QT at the time, and that would lead to about just over 700 billion of net issuance needs kind of like clipped away from what Treasury has to do. So that would substantially drop marketable borrowing again. And the third is just the shape of the curve. We've had this inverted curve for so long. Hedging costs have been so prohibitively expensive for foreign investors who would have to be buying on a hedge basis. You know, like a very popular example is the Japanese hedged investor base, which is the largest kind of the buying base from the country. Well, we have had positive net flows from Japan this year, just looking at Treasury's tick data, but it most likely was from the unhedged side of kind of the more official flows, as opposed to what you would expect from the typical lifers and banks and so on. If we actually do see rates coming down and the curve steepening again, that naturally brings in foreign demand, not just from Japan, but generally from the world. It probably implies that, well, if it's bull steepening, it probably implies that demand for fixed income overall will be larger. And B, you can just kind of look at historically, let's say, Treasury auction performances. There's a very clear connection between the shape of the curve and foreign participation in auctions. So I think at the time when people are getting worried about fixed income and demand for fixed income, the economy will be able to slow down, and the macro factors will outweigh any fears of indigestion for supply. I think there's always this kind of permanent fear or underestimation of how much demand there is for U.S. Treasury at the end of the day. And I think by the time we kind of reach middle of next year, we will have turned a page in the cycle, and supply will be a secondary worry.
Let's hope so. Joann, on the European side, deficits are still going to be high there next year, we think. But European governments, more than other governments that, in 2023 have been able to rely on both NGEU financing, so the EU's recovery fund that was introduced during the COVID years, but also, more importantly, retail investment has proved a big source of support for many European governments. Do you expect that to still be as much of an offsetting factor next year, and therefore perhaps lessen your concern about the impact of lots of supply on bond yields?
One of the biggest marginal buyers, I think, for 2023 really has been the retail sector, including both kind of corporations as well as non-financial corporations and households. I think that's likely to be a very similar story for 2024, where we see the kind of household sector and retail sector step in again and absorb supply. We've seen with government-specific retail bonds that actually there's been pretty high demand from issuers like Italy, Belgium, and Portugal as well, where retail demand has really stepped in and taken in these bonds with quite a lot of enthusiasm. There's still a lot of cash in overnight deposits in Europe, and I think there's kind of room for a further reallocation there, where we've seen a trend this year of moving away from overnight deposits and into kind of deposits with a bit more term, as well as government bonds. And I think that trend should really continue for next year. The kind of levels we're seeing in overnight deposits are definitely kind of higher than the pre-GFC trend. So I do think there is kind of space for retail deposits to move out of overnight and into something more long term. And I think that will, of course, be a supportive factor for supply into next year. But I think all things considered, the supply picture for 2024 looks fairly similar to what it did for 2023. We're penciling in around 1.16 trillion in European EMU10 government supply for next year in terms of gross supply, which is fairly similar to our estimate for this year, and is a bit more of a rounding error. I think in terms of net supply as well, it looks fairly similar. The key kind of change between this year and next year in terms of net supply clearly is the ECB. We've had a year this year where the ECB came in quite phased with PSPP unwind, so like a very gradual approach throughout this year for actually rolling off bonds that roll off under PSPP. In contrast, next year we get a whole year where the ECB is unwinding their APP purchases, and on top of that you could get a scenario where PEP as well is unwound ahead of their end 2024 deadline. So our kind of base case is that PEP moves into mid-2024 from end 2024. So really for supply, it's another year of pretty heavy supply. Retail can offer some kind of support that, but I think it does kind of matter for our spreads view. Particularly for BCP bond, we are fairly bearish here, looking at 210 basis points for the BCP bond spread, and that's really been driven by the story about PEP. We've seen over the last few weeks really that Italy has been fairly directional and has traded to a beta with outright rates. But I do think that for next year, when the PEP discussion gets reopened once again, we should see a bit of widening pressure in BCP bond once again. I think after that widening, after that story is complete, we could potentially see a tightening once again if we get a year where retail supply is strong, where EU funds are not an issue like it was for this year. I think, you could potentially see that kind of bullish move overall actually come as a positive for Italy as well. So yeah, that's kind of our key views on supply for next year. But moving on to the UK now, Imogen, you seem more worried about the supply outlook in the UK than we are in kind of the US and the Euro area. So what kind of drives that view?
Yeah, I mean, I guess going back to what you said, Joann, the supply picture in the UK looks very similar in 2024 as it did in 2023. Anyone thinking that this was just kind of a one-off hit to supply because of, kind of cost of living related or energy related expenses is a bit misguided. We're talking about a multi-year regime shift on the supply front in the UK, which persists into 2024. Without going through all the kind of numbers in detail, I think that the net supply picture, net of QT or net of central bank activity, looks actually, heavier next year. So there's slightly more duration or slightly more net supply for the market to absorb, although of course the DMO may choose to limit the duration impact of that by shrinking some of the maturity of that issuance. But overall that won't change the narrative that supply will still feel very heavy in 2024 as it did in 2023. The reasons why I'm a bit more concerned about how this gets taken down in the UK, or why I don't think that the kind of turn in monetary policy will have as big a bullish influence on longer dated yields in the UK as it might do elsewhere, is really, simply I think we can split it down to both the supply story and the demand story. So on the supply side, you have a step up in supply over the next couple of years relative to the kind of pre-COVID decade that is much bigger when you look at the size of the market compared to the US, for example. If you look at net supply, net of central bank activity in the US, that's pretty much doubling next year, we think. Whereas if you look in the UK, doubling compared to the 10 years pre-COVID. Whereas if you look at that in the UK, it's kind of 4.5 times bigger, which is quite a sizable increase for the market to take down. You also have QT increasing in pace next year. And now, of course, we think that quantitative tightening in the euro area also increases in pace. But relative to the size of the balance sheet, the BOE is undertaking sovereign QT at a much faster pace than the ECB is or the Fed is, for example. And we know that the BOE is somewhat unique in the fact that it's actively selling bonds, which means it's locking in a loss in a way that the ECB and the Fed aren't, but also the way in which it finances those losses is very unique to the UK. You know, the Treasury are immediately on the hook, essentially, for any losses related to QT, which means that those losses immediately add to government funding needs, which ultimately translates into more gilt supply. So there's a kind of twofold risk, if you like, from QT, which is unique to the UK. But you also have these unique shifts on the demand side in the UK, which I think mean that the heavy supply outlook weighs more heavily. You've had a structural shift on the demand side in the UK in that, you know, where the DMO could previously rely on liability-driven investment, LDI pension funds, to hoover up a very large proportion of the debt that they were issuing. That hasn't been the case this year for many reasons that we've been through kind of throughout the year on the pod. But there's been a real kind of structural shift, and there's many reasons to think why, although LDI demand will return, I don't think it will ever return to the kind of size or scale that it once was in the UK. And you also have, you know, Jan was talking a lot about how supply will be absorbed in the US and about how high yields there will encourage demand. And you have a lot more passive demand for treasuries, I think, than you do in the UK, for example. If there's anything we've learned over the last couple of months, I think that there's been a real psychological scarring when it comes to all of the events that have happened in the UK over the last kind of 18 months. So here I'm not just thinking about the kind of volatility of last autumn with the fiscal events and then the LDI crisis, if that's what you want to call it, but also the fact that, you know, for a long time this year, the UK has looked like an outlier on the sort of global inflation front. The central bank reaction function has been much different to its peers at points and quite difficult to read. And I think all of that combined means that, you know, UK assets demand a higher risk premium than their global peers in order for markets to take them down. And you know, what we're seeing at the moment is that gilts just don't offer that additional risk premium. You know, they don't look as cheap on a cross market basis as they have. And I think that means that going forwards, supply will be more difficult for the market to absorb. I think for, you know, overseas investors, which aside from the BOE and LDI are kind of the next biggest sector that have traditionally bought gilts, need to see a still quite significant cheapening on a cross market basis to take those gilts down. So lots of reasons, I think, why supply can weigh more heavily in the UK. And that's one of the things that's really driving our, I guess, UK underperformance view, not just the fact that we see a kind of later cutting cycle than we see in the euro area and a shallower cutting cycle than we see in the US, but also the fact that we expect supply to weigh more heavily at the long end of the curve. And of course, you can kind of see that by our 10-year yield targets that I went through, you know, 4% in treasuries and in gilts and 2.3% in bonds. Obviously, that implies, relatively speaking, a much larger rally in treasuries and in bonds to reach those targets. I guess it's difficult for us to, you know, talk too much about supply without answering the question that, you know, I get frequently, or certainly did this time last year, because regular listeners will know that we entered the year with a very bearish view on gilts, which again was also driven by this kind of supply demand imbalance. And the biggest pushback that we got there was that everybody knows that supply is going to be high, and therefore it's kind of, you know, well telegraphed and already in the price. My answer to that would be that yes, that's true, but there's also a kind of flows element to supply, which I think the market underestimated this year, and I think it's in danger of underestimating again next year. But I'm keen to hear how you guys are thinking about that in your regions. You know, do you think that the supply outlook is already well priced, and therefore the kind of monetary policy pivot will dominate more, or how much do you think supply really does matter next year? Jan, I'll start with you, and then we can move on to Joann.
So if the last couple of refundings show us something that supply does matter for the immediate price action, but you know, I think over a medium term, to kind of take your question from the back, I think over medium term, the impact of monetary policy will significantly outweigh anything that we would get in supply in terms of, because there's a certain baseline that's out there as far as deficit estimates. Now, I will say the deficit estimates that you can kind of work out from Treasury's forecasts are significantly smaller than what we have, as in like the estimate deficit to be smaller. So I would say that if we would get a surprise on the supply side, it probably would be towards more supply rather than less, and that could add kind of immediate pressure on longer term rates, steepening the curve a little bit. But then again, it matters really what part of the economic cycle we are. When at the November refunding, we were still at a fairly good place as far as the economy goes. So you could have these bear steepening moves, or I mean, I guess in this case it wasn't a bear steep, but it was a massive rally. You could have these massive rallies on the back of supply adjustments. But I think as we get closer to next year and each subsequent announcement, market participants will do we'll get a little bit more up-to-date data, and they'll be able to kind of see that the current forecasts are pretty rosy. So I don't think it's fully priced in, but you kind of alluded to it. I think the impacts of monetary policy will significantly dominate, and if there's a slowdown in the economy, then Treasury and the Fed can take actions to try to keep that supply low through other methods, like we said, shortening duration and EQT and so on. So yeah, in the near term, I would be cautious around these refunding dates in the US, where we announce how much issuance we expect. But other than that, I don't think are priced in. But other than that, I don't think kind of more medium-term impact of supply needs to be kind of added to the curve from here on. I think it will just keep adding upward pressure rather than just like fundamentally shifting where we are in yields.
Okay, that makes sense. And Joann, same question to you then.
Yeah, so I think in terms of supply, it clearly is a fairly important kind of factor, and I think it will continue to weigh on the long end. But I think what's been interesting recently is that we've seen this kind of back end repricing really being led by the US, and at levels with bonds at 2.9 or 3%, we've really seen some fairly strong buying or appetite to buy at those levels. So I do think that, even though supply matters, I think it only matters in as much as how much demand there is to take bonds in at those levels. And I think for next year, we're really entering a period where all three global central banks are set to cut, and I think it's very difficult to be anything but bullish going into that. I think for 10-year rates, there's kind of two really big themes really for next year. The first being the rate cutting cycle, and the second being supply. And I think if you kind of put the supply picture into our Bund model, for example, we would get an estimate of Bund 10-year bonds at around 2.9% for the end of 2024. And in my view, I think the model perhaps overweights the impact of supply there. Where I think if you have a fairly easy linear regression with just what happens in the front end, you'd see bonds at completely the other end of the spectrum at 2%. So I think the reality probably lies somewhere in between, with bonds around 2.3%, with supply obviously weighing on the back end and counterbalancing some of that reduction in the front end from the rate cutting cycle. But I also think this kind of demand story is important here, with kind of demand coming back in before the end of the end of the holding part of the cycle, where we could see buying coming in to kind of get ahead of the rally that we're likely to see earlier in the euro area versus the US and the UK as well. So yeah, quite a lot of different levers pulling in different directions, but I do think the kind of path for rates is lower, but also towards steeper curves given the supply picture.
Yeah, that makes sense. Thanks, Joann. I guess it's difficult to talk about supply, or really the year ahead in general, without mentioning, the political landscape and how that might change and how that might influence all of the things that we've talked about, because obviously we've got key elections both in the US and in the UK, we think, next year. So Jan, how are you thinking about elections and how that might matter for A, your view on supply, but B, your view on rates in general next year?
So in the US, there is this view that fiscal spending tends to increase during election years. And that is most likely rooted in some truth in history. Of course, we have to differentiate from the counterfactual of what was happening in the macro sense, and it being an election year. Also, the composition of Congress is very important. But I should say into next year, spending will be a little bit more difficult because of divided Congress and even within parties, there's still like visible divisions now. My base case is, like I said, deficit will increase, and we have seen that through executive orders. We could get a lot of kind of spending packages passed and discretionary spending boosted. So I think we will see if there's any risk to spending from the fiscal side, it's probably to the upside rather than the downside. And there are a couple of both headwinds and tailwinds of timing of cash flows, what might be required, how much the economy will slow down, which in turn leads to like even automatic stabilized like unemployment and such that increase spending. And there's still a lot of kind of unknown knowns, but my guess is that if anyone has to draw a direction towards where deficit's going to go into next year, I would say towards a larger one rather than a smaller one in the US.
Yeah, and I guess just to wrap it up on the UK side, we would probably have a very similar view. We expect any and all fiscal headroom to be recycled ahead of the next election, which we expect to be in autumn 2024. Probably on the UK side, we have, well, according to the polls at the moment, we have a clearer view of what the political landscape might look like at the end of 2024 after the election than we do in the US. But I think the point really is that the supply outlook or the narrative around supply won't shift meaningfully whoever is in power after the next election. There's very little headroom, fiscal headroom, and very little kind of available spending, and that doesn't shift with either government. Both the Conservatives and the Labour government have promised to stick to the current fiscal rules, and within that, like I say, there's very limited headroom. We have a Conservative government who have spent more than you would probably traditionally consider for a Conservative government, and we have a Labour government who are already kind of diluting down their promises when it comes to spending. And I think one of the lasting legacies of all of the fiscal events and the market volatility that we had in 2022 is that it probably taught both sides of the political spectrum where that red line is when it comes to borrowing and what the markets will accept, I guess. And so that kind of shores up fiscal orthodoxy on both sides of the political spectrum. And so although an election in theory feels like a big event and a potentially big driver of markets, actually, we don't expect it to be the case this year. Anyway, that's probably enough. I would suggest that if anyone has any other questions that they would like answered in the year ahead, they should, if they have access to our strategy pieces, they should read the full document, and I'm sure we'll be discussing our views for 2024 in many of these Bondcast episodes to come. So thank you both for joining me. Thank you to our listeners for tuning in. And just a reminder, if you liked today's episode, please don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available. Thanks.